Well, I think that really depends on inflation, and the BSP will respond as a result. Now, it seems like inflation continues to be elevated. The latest number that we had recently showed the 5.2% print. So that's increasingly more likely that the BSP will hike. The market is looking at about 50 basis points. I think the probability that they'll do that is getting higher as we get the inflation numbers come out. Yes, well, fixed income or bond investing is actually an integral part of anyone's portfolio. In a rising interest rate environment, it becomes necessary for us to try to manage our holdings because bond prices adjust as interest rates move up. The upside is, as interest rates move higher, we actually enjoy much more income or much more yield from the investments that we have. So I think should we invest now? Yes, I think so. It becomes more worthwhile now that rates are higher. It's just that we have to manage and choose the bond investments that we have, cognizant of what we think interest rates will do in the short term. Well, inflation, we think, will continue to remain elevated in the next few months. As we go through the year, we do expect inflation to start moderating as the market or as prices work out the base effect, so the impact of the additional taxes and all that don't affect prices too much anymore. And also the recent action of the central bank, I think, will help keep inflation expectations in check. So far, it looks like we'll continue to see an uptick in the prices of goods and services, but longer term, we do think that will start moderating to more normal levels. I think this will actually help the local bond market by making the secondary market much more liquid and much more active. If you have big issuances, typically the investor base is wider and a lot more people are involved in that market. So a lot more secondary market liquidity for bonds in general. Having said that though, in the short term, there is a lot more supply coming into the market. So you'll probably see investors demand a higher rate to be able to absorb those bonds. But longer term, it's generally good for the market that you have these big bond issuances. Well, the peso has been weakening because there's been more dollar demand relative to dollar supply. Over the short term, I think it's the general expectation of the weakness of the peso that has caused investors as well as corporates to start buying dollars ahead of their requirements. Moving forward, we do still expect a little bit of a weakness in the peso, but we do expect that the moves will be much more moderate, especially given the levels that we are at, around the 53.50 area. As we head into year end, the dollar supply coming from OFW remittances should help moderate significant weakness in the peso.
Well, first of all, the currency. The weak peso has made it less palatable for foreign investors investing in Philippine stocks. If you look at the 5-year return on the PSEI, it's at about 23% in local peso terms. However, if you convert that into dollar terms, the actual return is actually negative 0.4%. So while one can argue there are economic benefits of a gradual currency depreciation, it has actually eaten into returns of foreign fund managers investing in Philippine stocks over the last 5 years. Then there's also concern on monetary policy uncertainty. You have rising inflation, an expanding current account deficit, and more recently, the recent sell-off in emerging market equities triggered by rising US bond yields and the strengthening of the US dollar. And this has triggered a classic move out of risk assets, and in this particular case, emerging market equities. Well, first of all, the currency. We think that the big move in the currency is over, and we think that this will make the Philippine market conversely now more palatable for foreign investors. We also expect inflation to taper off in the second part of the year, or in the second half of the year. We also anticipate relatively less monetary policy uncertainty, and we also anticipate a boost in corporate earnings growth in the second half of the year as bank earnings recover in the second half. Just on the back of this, I wouldn't be surprised if the market stabilize and even rebound strongly in the second half of 2018. Well, we continue to be bullish on infrastructure-related stocks. We still like property. We are fans of consumer discretionary related stocks, and we also like the banks. It all starts with our team's constant monitoring and assessment of risks, which is embedded in our equity process. Whenever we think risks and uncertainties can potentially go up in a big way, we usually raise cash by selling what we consider to be non-core positions or satellite positions or trading positions. This may comprise about 5 to 15% of the portfolio. We then keep our core holdings to weather the storm. However, if we think risks can potentially rise to crisis-like levels, we then also reduce even the level of core equity positions. Yes, this is the time to start reinvesting in Philippine equities. Well, first of all, it's very difficult to find the exact bottom of the stock market. What we do know is that the risk-return proposition on Philippine equities is probably now at its most attractive over the past compared to the last few years. This is because we consider the risks weighing down the market as manageable. Foreign selling has been excessive, our macroeconomic fundamentals remain strong, and as the market valuations have fallen to more reasonable levels.